What is going on, YouTube? We have another video and we are in the beginning of earnings season here. I would have these videos coming out a little sooner, but did catch a bit of a cold, so better late than never. So what we're going to do in today's video is go over ServiceNow, ticker symbol NOW, and we want to take a look at their financials and see how they are doing. As we can see on this stock chart over the course of last 1 year, 12 months, stock's up 66%, and just year to date, we are up 9%. And they reported their earnings about 3 days ago and beat on top and bottom line. And their earnings were fantastic. And then their guidance as well, which we'll go through a little bit of their guidance that they forecasted for us. And with their guidance, basically every analyst has revised their expectations higher for their next quarterly results. The company currently has a forward PE of 58 and a forward earnings per share of $13. So we will plug those numbers into the valuation spreadsheet to figure out the forward-looking valuation on this company, because obviously the market in general is pricing in a lot on this one, and rightfully so, because the growth rate on it is very, very, very good. So on their earnings call that they reported to us, they gave us a little bit of guidance. So they're raising their 24 outlook to reflect the strong momentum which they saw all of last year. So that's very positive, obviously, if you are a shareholder. They're raising their subscription revenue outlook by about $165 million. And that then it gives them a range of $10.5 to $10.57 billion. And that's given them about a 21.5% to 22% year over year growth. And then also they're expecting subscription gross margins of 84.5%. And then they're also raising their full year operating margin target from 28% to 29%. And then expect free cash flow margin of 31% as well. So, I mean, just every aspect of the business, every key point of the business is growing. Their margins are expecting to get better, and their revenue is going to continue to grow as well. So, I mean, once we get over here to the overall financials, we'll see that this company continues to grow and grow and grow, and their margins get better and better and better. So, they've proven that in the past. So, their guidance then becomes more believable, and you can then price that in, and then that's why these stocks run up, assuming, and if they miss on those expectations, that's why they sell off. And again, if you want access to this spreadsheet, it is available on Patreon. There is a link down below. So over here, revenue, gross profit, net income, we've got all three trending higher. We really got revenue and gross profit really trending higher, but net income not as strong. We do see, though, in the trailing 12 months, a very steep increase to their net income. However, once we get over to their most recent 10K, there is a little bit of a caveat to that. So we'll take a peek at that as well. But obviously on a chart perspective here, this looks very good. Margins, we can see, continue to just grow and get better and better and better. Also, one side note here, last quarter, this is not the most recent quarter. This is the quarter prior. It usually takes a few days for these numbers to get imported into the spreadsheet. So it definitely, these numbers are not current as in the most recent report, but this still gives us a very good understanding of how the business is performing. But we got net margin trailing 12 months 18.7%. As we can see, there's a big something going on here that's helping them see a significant increase to their overall net income. Company's got about 12% return on invested capital, earnings yields, and about 1% cash to short-term debt. Again, this is another company that provides a service. So this chart still looks okay, but once we get over to their balance sheet, we get a breakdown of their balance sheet. This is actually, their balance sheet is very strong. So right now it's looking like, not that it's okay, but nothing to be too excited about based on what we're seeing right here on these charts. Net income to free cash flow, company produces, I mean, just look at that trend of free cash flow. I mean, just continues to grow year over year over year, and it's just very consistent. So that's very good, very nice to see. We can see here's our free cash flow. It's just like a ladder going up higher every single year. Capital expenditures continue to grow as well, but they're very nominal in comparison to their overall free cash flow. So not a concern whatsoever, but very nice growth on free cash flow. Share count dilution, they have not really been doing too much more dilution as of what we can see lately, so that's good. Obviously, they don't need to. They don't need to raise any more capital. So hopefully the dilution gets throttled back, and maybe we can start seeing them not spend so much stock-based compensation, or if they want to continue paying out stock-based compensation, they offset that by buying back more shares, which we can see they did buy back a little bit of shares. So maybe in the future here, we can start to see them buy back a little more shares to offset that stock-based compensation. Company does not pay out a dividend. So now let's take a look at their 10K that they reported. This is the most recent numbers that we've got. So these are going to be 1 year annualized numbers. And this is the balance sheet. This company's got $4.9 billion in cash. So we can take our cash and cash equivalents plus short-term investments. So they've got about $4.9 billion in cash. We come down here to overall liabilities. So this is what I was talking about. Liabilities here. Because this company provides services, they have deferred revenue. So these people, these customers that they have already paid them, but they have not provided the service yet. So currently it's a liability because the service has not yet been provided. So that is a liability, but that will eventually transfer up over into assets. So whenever I see deferred revenues, I always get rid of that on the liabilities because that's not technically a liability. I mean, it is, but it's not, because the company's gonna provide that service and then it'll earn that money. So then we subtract off $5.8 billion, and then that leaves us with about $1.6 billion in short-term debt. So you take off 5.8 from total liabilities and you're left with about $4 billion in total debt, and you've got $4.9 billion in cash. So the company's got more cash than it has in total debt, which is fantastic. So very good, very strong balance sheet there. Now I come down here to our net income. We've got total revenues, and we can see year over year revenues continue to grow, which is good. And they're forecasting continuous growth as well, about 22% if I remember right. So still going to see very good, strong growth within this business as they are forecasting. And gross profit continues to grow, and operating expenses probably going to be expecting to continue to grow as well as the business gets bigger and bigger and bigger and provides more services. So income before income taxes. So this is where this income trajectory that we saw is kind of going to the moon here real quick. Is we come back over here to their income statement, they have provision for income taxes of $723 million. So that gets added in down here. We can see for net income. So they add that back in to their net income, which makes their earnings per share fantastic and makes their margins look really good as well. However, their margins are still probably going to be down in this range because that was a one-time deal. That's not sustainable. That's just a tax benefit that they got somewhere along the line. So I believe that, well, let's take a peek. So if we come over to Seeking Alpha, we can see we're on the income statement, we're on quarterlies. We come down to our income tax expense right here, $870 million this year that they got for a benefit. Obviously, these other 3 quarters will take away from that. That's why it's 723. So in 2 quarters, when the company reports, you're gonna see a net income of more like this versus 1 billion quarter over quarter, year over year. And then that's why you might see an EPS miss or not maybe a miss, but a growth miss where you might see negative growth, and that might spook the market real quick, drive the stock down lower. But once people dig into the numbers and see like, oh, it really wasn't that bad, then, again, that's gonna be a really short-lived window. But if you can catch that, you might get a real quick buying opportunity on Now Services when that is announced. So back to our valuation spreadsheet, we're gonna look at comps. The only comp I could really come up with that I could find or think of is IBM. So we'll compare IBM to Now Services. IBM also provides the ITSM. So we come down here in comparison for all of our margins. We got market cap, pretty similar market cap. However, revenue, a lot different. IBM does more than what Now Services does, but it does provide these similar services. And we can see 5-year growth rate on Now is just fantastic. It's going to continue that way. Margins, good gross, bad operating, but good profit. You got free cash flow. So you really got a lot of, I wouldn't say good and bad. I would just say, back and forth across these two companies. We got good gross margins for Now, bad, I guess bad for operating margin, but then good for profit, bad for free cash flow, but then good return on invested capital, but then you're going to pay a lot for Now Services. But you look at the growth rate on Now Services, you're gonna pay up for a company that's growing at the rate it is with good financials behind it as well. Now over to the calculators. We're gonna run this company's financials through several different calculators here to figure out what this thing is worth today, and then we will plug in forward-looking numbers as well to figure out what it's worth about a year from now based on, projections and expectations. So P&L's valuation gives them $267.96 per share. Our multiples comparison comparing to just IBM, 195.64. Our manual PE, it would take about 54, 55 years for this company to earn its current market cap. So it's pretty richly valued just based on that as well. Price to book, 5-year average, 21.86. Price to book did not populate back up in here for the average. We can refresh this real quick to see if it comes in. And so after we refresh, it comes in at 25.62. Price to book, 21.86. So we're below our 5-year average for price to book. So that's good. PEG ratio, very richly valued based on the PEG. We come over here to Graham's valuation, $563.76 on this particular valuation method as well. Over to our DCF valuation. So company currently has an average growth rate on their free cash flow of 31.5%. Analysts gave them a 24% growth rate. I'm going to meet them in the middle because they're obviously going to continue to grow. Their free cash flows look like they're consistently growing year over year over year. So I'm good at a 28% growth rate on their free cash flows. So that gives them a $601 valuation on discounted cash flow. Now, Rule 72, we have 3 sources of EPS growth rate because of the significant growth rate on this company because it's in its growth stage. I plugged in a 0 to reduce the overall average. So now our average is sitting at about 20. This is more of like a 10-year type calculator. So I want to keep that growth kind of on the low side because of how this calculator works. So because of that, that gives us a 20-year average growth rate. Then what we get to do is double our current EPS 2.77 times. So it puts us right in this range. I gave them about a 67, so it's still on the higher end. But that still gives them a fair value of $668.88. Now, if I was to plug in something close to where analysts or another analyst source for an average growth rate of 30, we're going to double our EPS by 4 times. That'll give us 135. And unfortunately, I don't think anytime real, maybe in 10 years, it's worth $2,000. But this is what we're saying today is what it's worth. But in future market value, we're looking at potentially $2,600. But today we're expecting $668 for fair market value. And then we throw a 30% margin safety on this calculator as well to tell us, okay, 468 is what we can potentially look to buy, like a buy range, right? So then we come over here to our summary of all of our valuations that we just went over, and our fair market value, the average of all of them is going to be $459.46. 30% margin safety is $321. Analysts have a price target of $719 per share. So one thing I'm wondering, so we valued this thing before, I do believe. So we come down here to now, and we valued it before at 455 to 318. So 455, where basically our valuation has been unchanged. And that was the last time we valued that one. And we valued that one, I believe, on the last earnings report. So now let's circle back and plug in our forward-looking numbers here and figure out what our forward-looking expectations are on this one. So we got $13.59, we'll call it for, so we got 13 for EPS, and then we got 59 for a PE ratio. So plugging in forward numbers, this is over the next 12 months, $414, 302 on our multiples. But then we come over here to Graham's valuation. We do see this is above where it's currently trading at $872.48. Our DCF won't change. Rule 72 will slightly change. We will want to see a double of 2.7. So we're going to be looking at about a 90 roughly for this one. So then that gives us a fair value of $890.50. So now that changes our fair market value to $618 and 30% margin safety, $4 or $432 per share. Now, on a company like this that's growing so fast, a margin of safety is probably something that just isn't gonna be there. I mean, if you can get it for fair market value on a company that's growing at 20, 30%, year over year, I would probably jump on that. So if we do get a pullback, to 600 some dollars per share, I would probably be a buyer. So now let's hop over to the stock chart and see how this thing is doing. So we have this long-term orange trend line that we can see. Every time it pulls back to that line, it finds its way back up higher. We do have a few support lines in here as well. We have all-time highs. It chopped around here as it was resistance, and it was, but it since then has broken through. We do have more resistance. Now it would be support at, this green line, which would be about $606 per share roughly. And you got even more support. You have basically double support down here in the $500 range. If this thing manages to get back down here, that's a back the truck up moment on this one, or something catastrophic happened within the company. But I don't know. I think we have a potential. I mean, we come over here, we see the RSI, we're overbought territory. Our MACD is getting really extended. It's at all-time highs in the MACD. I think this company is definitely due for a pullback. And if we do get a pullback to about this $600 range, that's below our fair market value trailing 12 months or forward-looking 12 months. I think that is a very solid buying opportunity on this particular company. And I don't think you can go wrong with that one. So if something happens in the future here and we do get a nice little pullback, maybe the market decides to cool off a little bit, we might be able to see this thing pull back at maybe to 600 bucks. I don't know if I'd pick it up at 700 bucks. You could, but I think I would wait and stay patient, see if maybe start picking up some shares at 600, mid 600s, and just as it continues to maybe fall, grab more shares on the way down further and just kind of dollar cost average in and see if this thing pulls back to about here and then finds its way back up higher. I think that'd be a fantastic buying opportunity and play on this particular stock. If you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.